I think inflation is inevitable. Neither candidate has mentioned the fact that this debt is non-viable. You maintain the nominal entitlement around Medicare, Medicaid, Social Security, that kind of thing, but you inflate away the net present value of the obligation. In other words, some old geezer named Rick Rule, who has been promised $2,500 a month in Social Security, but $2,500 buys $400 worth of goods and services.
Is inflation about to make a massive comeback? What's going to happen to commodities? What's going to happen to financial assets? What's going to happen to our portfolio? Rick Rule is here to answer these questions. He is the founder of Battle Bank and the former CEO of Sprott US. He's also the president of Rule Investment Media. And Rick, it's always good to see you. Welcome back.
David, always a pleasure to be back with you. I'm delighted at the growth of your channel, which I've been watching with awe. Nice work, sir.
I appreciate your participation. It's because of good guests like you that the program continues to grow. Rick, let's start with economic growth. What's your sentiment for the economy? Advanced retail sales came in recently, much higher than expected. Inflation at 2.4% was lower than the previous month, but still a little bit higher than expected, although the trend for inflation is down. Are we going to get better economic data next year, do you think, or status quo for now?
If we maintain status quo, I would be delighted. I need to point out that the economic growth that we have seen has exceeded my expectations. I also need to point out that it hasn't benefited everyone equally. It's important to know that we have an economy that's becoming sort of a winners-take-all economy. Those people that have access to credit, as an example, and have the knowledge to use it, have done extraordinarily well in this economy. People who don't have contestable jobs, people who are wage takers, not wage makers, have had a tough time. And I don't know exactly how we address that. So there's that. I also understand your suggestion that we have moderated the rate of inflation, but I don't agree with it. If you measure inflation based on the consumer price index, the CPI, then what you say is true. But if you describe inflation the way most consumers describe inflation, which is to say the deterioration of the purchasing power of the currency, or the increase in prices in the basket of goods and services that they consume, I would argue that inflation isn't lower at all. The CPI, David, among other things, doesn't include food or fuel. If you don't eat, of course, that's not a problem for you, but most people eat. A second problem with the CPI, of course, is that it's hedonistically adjusted. They don't look necessarily at the price you pay for your house, your apartment, or your computer. They look at the function relative to the price as they see it. The third thing, and the most important thing, is that the CPI doesn't include tax. Tax is, of course, the most important household expense for most working American and Canadian families. And the idea that a cost of living increase doesn't include, that a cost of living index, doesn't include tax, makes it farcical on its face. I would suggest to you that if you asked your listeners to think about the period 2000 to 2024, and ask themselves what had happened to the price of their groceries, or if they were Americans, their health insurance, or their gasoline, or direct and indirect tax, and then you told them that the government told them that price increases were about 2.6% a year, compounded, they would laugh at you. I believe that if you measure inflation as the destruction of purchasing power in fiat currency denominated instruments, that the true rate of inflation is closer to 7.5 than to 2.6. And I think a lot of the things that I'm going to say in the rest of this interview would take that into account.
The expansion of, I would say, energy prices over the last couple of years has helped increase CPI, although we have seen periods like in 2015, for example, when the energy price has fallen below trend, and that's pushed down the CPI. My question now is regarding energy. What is your outlook on energy? What is your outlook on how oil may impact the CPI going forward. And this is important because Israel just retaliated against Iran. They did not hit oil refineries, and oil fell this week on the news. Your outlook overall on oil?
I suspect in the very near term, if geopolitical tensions subside in the Gulf, or better yet, if geopolitical tensions subsided in the Ukraine, that we would see moderating energy prices. But in the 5 year time frame, I see the price of conventional energy only higher. Here's why. Uh, Oil and gas companies have been constraining sustaining capital investment now for years. And when you constrain sustaining capital investments, you reduce your ability to produce 2 years from now, 3 years from now, 4 years from now. The International Energy Agency, by the way, no friend of the oil and gas companies, has suggested that on a global basis, including state-owned firms, that the oil and gas business, the industry as a whole, has been deferring or neglecting about $1 billion a day US in sustaining capital investments. That's precisely the type of investment program that caused Pemex, the Mexican government-controlled oil producer, to lose over 20 years 80% of their production capacity. The Venezuelans, through deferring sustaining capital investments, have lost 85% of their production over 25 years. So my suspicion is, unless the oil and gas business companies around the world return to their sustaining capital investments, we will surprise ourselves on the supply side within the 5 year time frame. The slack worldwide really has been made up by an increase in U.S. production. The most over-drilled terrain on the planet has doubled its production in 15 years, which is pretty amazing. It is arguable that with today's technology, the American production increase is, if not over, close to over. The industry itself, with some exceptions, Exxon and Pioneer as an example, report that they are mostly through their inventory of tier one drilling locations. There are a lot of tier one drilling locations left in Canada, but they go undrilled until your prime minister sees a business case for Canadian natural gas, which may not happen during his term. So I'm extremely bullish on the energy business in the 5 year time frame. I'm bullish in particular on those companies that are enjoying very high free cash flows, even at 66 US dollars per barrel, where they are both making the necessary sustaining capital investments and, as many are doing, increasing their returns either via buybacks or dividends to shareholders. Extremely, extremely bullish over the 5 year time frame on oil and gas stocks, perhaps not over the 6 month time frame, if we see the geopolitical disputes in the Gulf and in Russia resolve themselves. One more note, and I'm not Canadian, although I pay tax in Canada. Should Canada decide to thank and excuse their prime minister in the next election, I think you'd see the price of Canadian natural gas stocks double within a month.
Before we continue with the video, let me tell you about a very important statistic. Did you know that the U.S. national debt is nearing $36 trillion, with the federal deficit projected to exceed $1.5 trillion by the Congressional Budget Office in 2024, and inflation remaining a concern? Investors are increasingly turning to alternatives to fiat currencies like precious metals. This interest in fiat alternatives has pushed gold to new all-time highs in 2024. Some Wall Street firms are projecting even higher prices to come, with Goldman Sachs updating their year-end target to $3,000. Today's sponsor, Bullish Standard, an online retailer, offers a simple way to access precious metals. Their US-based team, with over 24 years of combined experience, provides fiercely competitive buy and sell pricing with personalized education. As PGCS and NGC authorized dealers with an A+ rating from the Better Business Bureau, they're committed to helping you own your choices with confidence. To learn more, visit bullionstandard.com/David Lin and sign up for their newsletter to receive an exclusive offer. You can click on the link down below or scan the QR code here. They look forward to serving you with excellence. So, significant policy change needs to happen there. Well, what exactly would a new administration do that may propel oil and gas stocks up by double?
Your prime minister has said that he doesn't see a business case for export markets for Canadian natural gas. Those are his words, not mine.
Mm-hmm.
The Alberta gate price is about $1.50 per million BTU, Canadian dollars. That same gas landed in Rotterdam or Tokyo or Shanghai sells for about 10 Canadian dollars. It takes about $2.50 to get it there, transmission, liquefaction, deliquefaction. So all in, about $4 Canadian in cost and about $10 Canadian in revenue. In other words, a 60% project margin. And somehow your prime minister doesn't see the business case for it. The
Well,
customers do, the
yeah.
suppliers do. I guess the business case, the lack of business case, has to do with the fact that he won't allow it.
Well, if that were to change, would that not be a bearish case for oil, at least from a production standpoint? It would we
I don't
would
think
it,
so.
we would
The
increase
price
supply, would we not?
the price disparity per BTU
Mm-hmm.
between oil and gas is almost 50%.
I see.
Uh, the what it would be is a huge boon for the Canadian producer. I note that there is still the slow debottlenecking, particularly on the Pacific coast in British Columbia, of natural gas export facilities. And so some of the problem will resolve itself with or without the prime minister's intercession.
If oil were to rise over the next coming years, if oil energy prices become higher relative to today's prices, what does that mean for the cost of living, Rick?
I think it really depends on who you are and how energy intensive your life is. If you want to look at the worst case scenario, take a look at Germany, where the industrial base is following out as a consequence of very poor energy decisions. My suspicion is that in North America, we live in a fairly fortunate bubble. We have a lot of infrastructure related to other forms of electrical generation, including nuclear. And my suspicion is that that would inure to our economic advantage relative to our peers. But certainly, people who are used to declining energy prices in real terms um, wouldn't benefit from higher energy prices. Investors, of course, would.
Well, do you buy the argument that if energy prices rise, that would feed into all aspects of material production, industrial production, and so the margins of companies would either have to shrink or prices would go up to maintain margins?
Energy intensive businesses, yes. I mean, certainly as an example in the mining business,
Okay.
an important input is energy. And one of the reasons why we've seen fairly muted returns in the mining business, despite increased commodity prices, has to do with the fact that input costs have been rising too, including energy. Uh, Oil and gas prices in the last 4 years, as an example, are up fairly substantially. And the consequence of that is that in heavy industrial utilization, like mining, increased energy costs are problematic. Traditionally, some technology companies, as an example, companies that have very high margin with very low input costs, haven't been impacted. But certainly, one would expect that some of the technology utilizations in the future, like data centers, as an example, would be impacted by higher energy prices. It's useful to note in that regard the resurgence in industry that the technology sector has focused on nuclear,
Yes.
saying in effect that they would be easily willing to double the price of electricity if that electricity was 24/7 available. In other words, very high quality electricity. And if that electricity could be delivered to them with no carbon output. It's interesting that some industrial users are willing to pay substantially more than they pay now for electricity.
Okay, well, that leads into my next question about market expectations. So if you take a look at my screen now, I'm going to show you. Um, a few charts. This is the DXY. It's been on a trend, an upward trend ever since the beginning of October. If you take a look at gold, which we'll talk about in more detail later, gold has also been on an upward trend all year, basically. But the rate of growth has accelerated since the summertime. And if you take a look at the U.S. 10-year break-even rate, which is a measure of inflation expectations, that also rose coincidentally with the rise of the DXY, which I just showed you. All these three things rising, the inflation expectations, gold, and the dollar, are they related to each other in some way? Is there another shift that's happening in the market that these prices are signaling?
I have only seen this occur twice in my memory. The first time in the early part of the 70s, the second part, 99 and 2000, where the gold price rises in US dollars while the US dollar rises against other currencies, and where the expectation of inflation in dollar terms, which is to say the TIPS yield, rises. Uh, in both of those cases, the subsequent period was extremely good for gold. I'm not saying that past is prologue. What I am saying is, and this will sound fairly nuanced, David, but I'm sorry. There's a joke that the US dollar is the worst currency in the world, with the sole exception of all the others. And I think what you're seeing in US dollar strength is the understanding that for all its faults, the US dollar still is the currency of trade and settlement. And it's also the trade that the world's debt is denominated in. The consequence of that is that demand for dollars continues strong. It is also true that despite the policy weaknesses in the United States, policy weaknesses around currencies in other countries are even more extraordinary. And the interest rates in those countries relative to the depreciation of their currency's purchasing power, is at least perceived to be worse. So we have a circumstance where there is an expectation in the market that the real rate of inflation isn't measured by the CPI. And we've seen a circumstance where the Fed has been actively intervening, lowering interest rates, but the market response is higher interest rates. In other words, the Fed cuts their Fed rate, and the yield on the 10-year and the 2-year go up as opposed to down. I think the market is expressing the same understanding that I tried to explain earlier in this interview, which is to say that the CPI is not a good measure of inflation. And I think that savers are requiring higher yields on US dollar denominated instruments than the Fed would prefer. That lack of faith in the purchasing power of the US dollar, which has resulted in a higher market interest rate, is also resulting in higher gold quotes. And the relative weakness in the US dollar notwithstanding, near-term strength, longer-term weakness, has been offset by even greater weaknesses in competitive currencies like the euro, currencies like the renminbi, currencies like the yen. An interesting circumstance, one that's traditionally been extremely good for gold.
JP Morgan Chase CEO Jamie Dimon has said that
the remilitarization of the world, which is inflationary, demographics is inflationary, the green economy is inflationary, the restructuring of trade is inflationary. So I see a lot of inflationary things in front of us. They haven't all happened yet, but they're going to happen, and I think they will probably have an inflationary effect. So in the back of my mind, we're prepared for that. I don't think it's a big deal if it's 3.5%, the 10-year bond goes to 5 or 5.5. I think it becomes a big deal if it goes much more than that, and people are caught off guard and credit spreads start to gap out. And it's only a really big deal if we have stagflation, i.e. a recession with inflation. And I would not rule that out.
A worst case, the worst case scenario worse than a recession, is a recession plus inflation. So an extreme case of stagflation. That would really greatly erode our standard of living, because on the one hand, we have low growth, and on the other hand, our purchasing power decreases exponentially. How likely is that scenario given today's conditions?
David, I'm not an economist, so I want to disclaim this. I'm a credit analyst. I lived through stagflation, the decade of the 70s. So did Mr. Diamond, and it is certainly no picnic. I am hopeful, although I'm not an economist, that the vestiges of globalization, the fact that we have the continued relative strength in the Chinese economy and in emerging markets economies, and the fact that our economies now are more reliant on technology relative to capital than they used to be, that we can escape stagflation. I think inflation is inevitable, absolutely positively inevitable. I think a slowdown in the economy is likely, but I'm less certain about that. I hope with every fiber of my being that what Mr. Diamond suggests does not come to pass. The period of the 1970s, while it was not unpleasant for me, I was involved in gold and natural resources, was extremely unpleasant for most people. And my hope is that people can avoid that sort of decade.
Are you expecting any sort of change, fundamental change for the economy and or our political system following the election, regardless of who wins? In other words, a constant change that will happen regardless of whoever is in the administration.
I think the biggest issue that's in front of us isn't addressed by either party or either candidate. That is the excessive size of the government relative to the size of the economy, and I'm talking in the U.S. context now, the incredible size of our debt. It would be useful for your listeners to understand that the on-balance sheet liabilities of the U.S. government are by now almost $36 trillion. But the off-balance sheet liabilities of the U.S. government are greater. Off-balance sheet liabilities mean mostly the net present value of entitlements, Medicare, Medicaid, Social Security, that kind of thing. That number in the U.S. context is now, according to the Congressional Budget Office, about $100 trillion. So the net present value of off-balance sheet liabilities added back to the on-balance sheet liabilities is, by the government's estimate, about $135 trillion. Interestingly, net private wealth in the United States is estimated by the Fed at $139 trillion. So the on-balance sheet liabilities and the off-balance sheet liabilities of the U.S. government come within $5 trillion of the private wealth of American citizens combined. We're dealing with these debts with a budget that's in deficit $2 trillion a year. Neither candidate has mentioned that. Neither candidate has mentioned the fact that this debt is non-viable. I unfortunately know how we work this out. You maintain the nominal entitlement around Medicare, Medicaid, Social Security, that kind of thing, but you inflate away the net present value of the obligation. In other words, some old geezer named Rick Rule, who has been promised $2,500 a month in Social Security, gets it, and he gets it for the next 10 years, but $2,500 buys $400 worth of goods and services. That's what we did in the decade of the 70s. According to the US government, in the decade of the 1970s, in 10 years, we inflated away 75% of the purchasing power of the US dollar. And my belief is in the next 10 years, we repeat that trick.
This is a good argument, certainly one that's been brought up before. Wouldn't you think that the government will just issue more debt on top of that? In other words, adjust for the amount of debt that they need given current
I do. Yeah. I absolutely do. And I think that will exacerbate the rate of inflation.
Okay.
Exacerbate not the CPI stated rate of inflation, which I think is false. It will exacerbate the decline in purchasing power of the US dollar.
If inflation expectations are going up, if everything you say is true, do you think that the Federal Reserve is going to halt or at least suspend their rate cuts into next year?
I am in contact with very low level employees of the Federal Reserve. And the Fed as an organization believes that they are the only thing that stands between us and the rampant deterioration in the purchasing power of the US dollar. There's a bias within the Fed to keep interest rates higher. The political reality at the top of the Fed is that they can't do it. And it will really depend on the state of the bond market, the state of the equities market, and employment stats. If they are able to withstand the pressure to cut the interest rate, the Fed as an organization wouldn't cut it, whether or not they have the political capability of not having a rate cut is a very, very different question. Both candidates have talked about having more political control over the Fed, which is to say, both candidates, both parties would like to see the nominal interest rate lower. We saw that in the middle part of the decade of the 70s. The interest rate in the period 1970 to the end of 1974 went gradually higher as savers demanded more compensation for inflation.
Yes.
The Fed was accommodative to the market. In 1975, there was political pressure to cut the interest rate. They did. They basically lost their nerve as the higher interest rate led to stagnation in housing. But in 1975, when the Fed capitulated, when they cut the interest rate, it was very. Pardon me. I'm sorry. When they raised the interest rate, the gold price fell in half, but it obliterated the bond market. It obliterated the stock market, and they lost their nerve and had some artificial cuts again. My suspicion is that if we had, and I don't want to be an alarmist. I want to say we're going to do this, but if we had a circumstance like 2008, if we hit some form of liquidity crisis, I think that the only defense that the political class has to that is artificially low interest rates and probably quantitative easing. If you saw that happen, that would announce to the market that the government had capitulated, that they don't care about the strength of the dollar, and they don't care about long-term solvency. All they care about is the election cycle.
So could we see then the possibility where in the future, if we have a financial crisis, that could actually be an inflationary, not a deflationary event like it has been in the past?
In the short term, liquidity crises are always deflationary. Mm-hmm. The policy response is always inflationary.
I see.
The difference, David, between now and 2008 is in the 2008 collapse, if my memory serves me well, the on-balance sheet liabilities of the U.S. government, what is commonly called the government debt, stood at about 45% of GDP. Today, that same number is 110% of GDP, which is to say that we have less policy options now than we had then as a consequence of the aggregate level of indebtedness.
Okay, let's come back to gold. Gold is a very interesting asset in that it has been agnostic to certain headwinds that we talked about. Some of these headwinds, like the dollar, rising dollar, for example, rising real interest rate. The 10-year real interest rate has been rising. Yet these things usually, which in the past have been bearish for gold, have not been bearish for gold this time. Why not?
Well, we've seen this before. Gold broke out in non-US dollar terms 4 or 5 years ago. It hit nominal all-time highs against most currencies 4 or 5 years ago. It's coming around to the US dollar. So even as the US dollar outcompetes even weaker currencies, gold is beginning to outcompete the US dollar. And I think that that's simply because some savers, pension funds, endowments, and the like, understand that the real versus the nominal interest rate in the US is negative. If I'm right, and the deterioration of the purchasing power of a basket of goods and services denominated in US dollars, uh, put differently, if the real deterioration of the purchasing power of the US dollar is actually, as I believe, about 7.5%, and you're getting paid 4.4 on a US 10-year treasury, rather than actually getting 4.4, you're losing 3.1 in purchasing power. In other words, the US government solemnly swears that they will reduce your purchasing power by 3% a year compounded for 10 years. Not a very good deal. The consequence of that is that you're seeing disintermediation out of US treasuries and into other instruments, including gold.
I see. Gold is at $2,700. Is it pricing in a certain presidential candidate, do you think? Or is
I
it
don't think it
agnostic to
is.
politics?
I mean, I really don't think it is. I think that the market is discounting a Trump win. I think both candidates are bad for the U.S. economy long term. I think the
Because they'll
financial
add more debt?
class,
Because they're
yeah,
adding. Okay.
exactly. I mean, they aren't dealing with any economic issues. What the candidates are doing is trying to bribe various voter classes by promising to lavish money on them. Um,
Right.
I think that the financial class sees less threat to themselves with Trump than with Biden. I think whoever wins the election, there's going to be an awful lot of discomfort around different segments of the US electorate. I think, as I say, a Trump election in the near term would probably be good for equities markets and probably good for the financial services sector. Um, I think that the financial class would greet a Harris election the same way they greeted the Clinton election, which is to say, extremely unfavorably. How long that would last is a different question. They're fairly adaptable folk.
Last week we saw a BRICS meeting take place in Kazan, Russia. Several important developments took place, including the agreement between India and China rather, to resolve a border dispute. Additionally, the BRICS summit welcomed additional members and talked about the possibility of expanding membership later on. Now, this ongoing development, the expansion of the BRICS, what changes does that expansion play for the American economy?
I think in the near term, it's much less of a threat than people think. You'll notice that despite continued talk about the BRICS members to have some form of common currency, that demand for US dollars for global settlements has increased rather than decreased. That chart that you showed about US dollar strength tells us an awful lot. You may recall, David, the last time that you and I interviewed, I described the fact that although places like Russia and China and India distrust us, they seem to trust us more than they trust each other. And using their own currencies as an exchange mechanism is really out the window. The Chinese don't want that many rubles. They'd be perfectly happy to settle some of their export debit with the Russians by way of Russian oil and gas, but they don't want rubles. And if they had a common currency, you get stuck with the sort of Euro phenomenon, which is to say the subsidization of Southern Europe by Northern Europe. That's the problem that the BRICS countries face. To the extent that they can develop a settlement mechanism that is much shorter term, where they can settle outside the dollar and they can free themselves from the weaponization of the US dollar. I think that'll be to their benefit. And I hope for their sake that they're able to do it. I continue to believe, and I should footnote here that I'm 71. I continue to believe that for the balance of my time on Earth, the US dollar will continue to be the medium of exchange and the settlement currency on a global basis. I think the US hegemony will decline. I think that countries will be more sophisticated in terms of bilateral trade. And I also think that gold will play an increasing role. But I don't think that gold itself will come close to threatening uh, the predominant market share of the US dollar in global settlement.
Do you see any changes to the nuclear policy of the US that may move the uranium price one way or another?
David, that has really surprised me. 5 or 6 years ago, the US society would have roundly vilified me for being a uranium investor. Now, the Biden administration is proposing to subsidize me. I actually felt cleaner when I was being vilified. But I guess as a uranium investor, if I had a choice between being threatened with federal litigation and threatened with a $5.6 billion subsidy, that I would probably prefer the subsidy to litigation. The acceptance of uranium in US society, led, of course, by the tech sector, has, I think, helped the political class adapt to the idea of nuclear power. Thought leaders in American society, not that everybody likes them, but thought leaders in American society, the new media, if you will, the Microsofts, the Googles, the Amazons, the Alphabets, are all flocking to nuclear power. While this isn't important on the demand side for 7 to 10 years, what it does is it signals a growing acceptance to uranium as a fuel. It leads to the potential restart of things like 3 Mile Island and the delay of decommissioning of 6 or 7 reactors in the United States. There is a real sea change of global sentiment towards uranium around the world. There is even now hints that Germany might reverse their own anti-nuclear policy, which is the most extraordinary anti-nuclear policy of any developed country on the planet. And one of the reasons why electricity prices in Germany are up 500% in 15 years. This is a real sea change in political will, in the narrative, and in policy.
Is energy a zero-sum game, which is to say, if we have more uranium investment and more nuclear production, then another source of energy production is going to be used less, and so we must be bearish on something else?
I don't think so, for a whole bunch of reasons. The way that you and I live, David, is extremely energy intensive, and it's going to get more energy intensive. You've heard, I'm sure, because you're a young guy, the impact of AI on electrical utilization, and the fact that the only way that we can meet this increased power demand for communications and technology is either through the generation of tremendous amounts of carbon through burning coal or nuclear power. But what those of us in the West don't consider, David, is that there's still 1 billion people on Earth that have no access to primary electricity whatsoever. There's another 2 billion people on Earth that have only access to intermittent or unaffordable electricity. There will be demands in the future for all kinds of energy. Wind, sure, where the wind blows. Sun, sure, where the sun shines. Nuclear, yes. Oil, yes. Gas, yes. And guess what? Worldwide, coal demand, that great energy pariah, is increasing, not decreasing. The entire world, David, wants to live like you and I do. And that's energy intensive. We have done a great job as a species increasing the material standard of living of humans over the last 40 years, lifting 2 billion people out of dire poverty to making them just poor. I believe we're going to finish the job in the next 20 years. And that's going to generate tremendous demand for power of all types.
Do you think supply will outpace this demand?
I don't. But I do think, well, I'm hopeful. I think supply will keep pace with demand. In order for that to happen, it's important to note that carbon utilization, coal utilization, oil utilization, gas utilization is going to continue to increase, whether or not the big thinkers like it or not.
Excellent. I appreciate this recap of the markets before the election, Rick. Where can we learn more from you and study your work?
People who like the way I think about natural resource investing can make it personal. Go to Rule Investment Media, my website, and list your natural resource stocks. By natural resource, I mean oil, mining, that type of thing. Please no crypto. Please no pot stocks. Please no tech stocks. Rule Investment Media, list your stocks for no charge, no obligation. I'll personally rank them 1 to 10, and I'll comment on individual issues where I think my comments might have value. And if you're American and if you're Canadian, blatant commercial here, if for any reason at all you're unhappy with your current bank, and I suspect that's all your listeners, check out battlebank.com or at the Rule Investment Media website. Just write in bank, and I'll send you news on my new bank, Battle Bank.
Has it launched yet?
We have a very important announcement this week, but I can't front run my announcement.
Okay, well, we'll follow up after the announcement has been made. Thank you very much, Rick. Appreciate it, and we'll put the links down below. We'll speak
Thank you, David. Again, congratulations on the great growth in your channel.
Thank you very much. We'll speak again soon and have you on the channel soon. And thank you for watching. Don't forget to like and subscribe.